Welcome to episode 24 of the SaaS Report. I'm your host, Matt Aird, founder at Sales Science, and we've got a jam-packed show today. We're right in the middle of Q2 earnings season. So we've got a bunch of Q2 results to look at. We'll be looking at numbers from Palantir, ZoomInfo, Procore, Confluent, and Cloudflare. We'll then do a bit of a deep dive or a kind of post-match analysis on Figma's incredible IPO and have a look at how their valuation stacks up to other publicly traded SaaS companies now that they're listed. And then finally, we'll close off today with a bit of a recap on OpenAI's latest funding round and kind of how that positions them moving forward. So let's get into it. Palantir just delivered one of the best quarters for a tech company, maybe ever. Just listen to some of these numbers. We had 48% ARR growth year over year. So they added 1.3 billion in net new ARR over the last 12 months on just $931 million in sales and marketing spend, right? So that gives them CAC payback of just 11 months over the last 4 quarters, right? Incredible in this operating environment. We're seeing everybody else, right, is seeing CAC payback rates go up. Palantir is finding a way to bring them down. US commercial revenue for them grew 93% year over year to 306 million. US government revenue was up 53% year over year to 426 million. And just listen to some of the deals that they closed here. So they closed 157 deals in the quarter of $1 million or more, 66 deals of at least 5 million, and 42 deals of at least 10 million for a total contract value closed in the quarter of 2.27 billion. That's just incredible for a company that's at $4 billion run rate right now. Be able to close 2.27 billion in TCV in one quarter is insane. 94% rule of 40, net margins of 33%, and they're also guiding to 50% ARR growth in Q3 this year. So just incredible performance by Palantir. Obviously, we did a deep dive on there a couple of episodes ago, so if you want to check that out, you can. What I did was looked at Palantir's performance from their IPO in 2020 through to today and compared that to a bunch of other companies that IPO'd in the same time period. So if you want to check that out, I'll link to it in the show notes. You can go and have a look. Right, one of the key things that we identified in that episode on Palantir was this pretty crazy ARR growth rate chart, right? So if we look at this chart here, we can see that they came out of the gates post IPO really strongly, right? Growing kind of north of 50%. And then that started to taper off and they really hit their low point in the middle of the SaaS boom, right? So kind of like 21, early 2022 period, they were struggling and then they've just re-accelerated growth post that point, right? Palantir is now at the point where they've increased their ARR growth rate every quarter for the last 8 quarters, right? And again, keep in mind, this is in an environment where everyone else is seeing growth rates just absolutely fall off a cliff, right? So congratulations to Alex Karp and team, incredible quarter, and it looks like they're projecting a few more incredible quarters ahead. ZoomInfo reported Q2 numbers this week as well, and they're finally back in positive growth territory. So they reported 5% ARR growth year over year. That's the first quarter they've reported positive ARR growth in the last 5 quarters. When we look at this chart here, we can see that since Q3 of 2021, ZoomInfo's ARR growth rate's been trending down massively. And as I said before, that culminated in kind of 5 quarters of negative ARR growth through 2024 and into Q1 of 2025. But they're back on a positive growth trajectory now. So they added $61 million in net new ARR over the last 12 months. And on top of this return to growth, they also delivered pretty significant improvements to operating efficiency. So income from operations came in at 53.7 million for the quarter, or about 18%. The big impact here comes in the form of reduction in G&A expense from 38% of revenue to 15% of revenue. Now, I think there wasn't a ton of commentary on this, but I think a lot of that comes from a reduction in write-downs on bad debts, right? They had struggled over the past kind of 12 to 18 months with SMB customers not paying their bills. They had to write off a lot of that debt. That falls into the G&A line. And so we've seen a reduction there from 38 down to 15. So good sign. All right, free cash flow was also strong for the quarter. That came in at 33%. But go-to-market efficiency, not great, and you probably expect that, right, when you're only adding 61 million in net new ARR. They had CAC payback of 99 months over the last 12 months, magic number of 0.14. Right, but the big issue for ZoomInfo, and this has been the case for the last few quarters, is that SMB segment, right? They're transitioning away from that segment, so strategic direction has changed. They want to move more at market. They want to get away from these smaller accounts that apparently don't pay their bills. We've seen some good signs here that they've started to get this under control. So provision for bad debts has reduced from 32.5 million to 9.9 million year over year. And their net revenue retention has improved as well. So from 87% up to 89% quarter over quarter. So some green shoots for ZoomInfo, still a lot of work to do, but definitely the best quarterly report they've delivered in the last 12 months. Share price was up 6% after hours after the announcement. I think that's since pulled back, but they're trading at about 3 times ARR right now. Got Q2 numbers from Confluent as well. They added 185 million in net new ARR over the last 12 months, spending 526 million on sales and marketing to generate that growth. That gives them CAC payback of 47 months over the last 12 months and ARR growth of 21%. They've now ticked over $1 billion, so they're at 1.08 billion in ARR. Operating margins improved big time year over year, so from negative 46% in Q2 of last year to negative 34% in Q2 this year. Free cash flow margin was up slightly as well from 1 to 4%. But that was about the only bright spark, right? NRR is down, so still strong at 114, but down from 118. Growth rate is down to 21 from 27, and rule of X is down to 46 from 55. When we look at their net new ARR added quarter over quarter trend here for Confluent, this isn't what you want to see, right? As a company grows, ARR growth rates will naturally decline, right? Because it becomes harder to grow at high rates once you have a large ARR base. But what you don't want to see is actual net new ARR added quarter over quarter decreasing, right? So even though you're growing at a slower percentage, you still want to be adding incrementally more ARR quarter over quarter. And Confluent has been heading in the wrong direction here. Net new ARR added in the quarter is down from 71 million to just 40 million for Q2 year over year. Rule of X was down as well to 46 from 55, and the share price took a hammering post earnings. So they had a 38% decline in share price. That Confluent now has a market cap of 5.9 billion, or about 5.5 times ARR. Procore added 158 million in net new ARR over the last 12 months, but they spent $570 million on sales and marketing to generate that growth. That gave them CAC payback of 55 months and ARR growth of 14%. That was down from 24% in Q2 last year. Not ideal, right, for a company that's at 1.3 billion in ARR. They'd want to be growing much faster than that and probably much more efficiently than they are right now. The problem for Procore is that net new customer adds have slowed pretty dramatically over the last few years. So we can see in this chart here that in June of 22, they added about 2,254 net new customers. The year to June 23, they added 2,300 net new customers. And then to June 24, so this was Q2 last year, they added 1,046. And then to June this year, that number's decreased to just 751, right? So they've been able to partially offset this decrease in net new customer adds with an increasing average contract value. So ACVs grown from 51K to 73K in June of this year. But from an efficiency standpoint, the picture also looks a lot worse than just 12 months ago. So free cash flow margin was just 3% for the quarter, down from 16% a year ago. Operating margin was worse too. That came in at negative 9% versus negative 5%. All right, so pretty tough going for Procore at the moment. Share price is down 17% year to date. They've got a market cap of 9.25 billion, or about 7 times Q2 ARR. All right, final report that we'll cover today was Cloudflare's Q2 numbers. So Cloudflare added 445 million in net new ARR over the last 12 months. That's 28% ARR growth, pushing them north of 2 billion in ARR. They've done a tremendous job over the last 2 years of keeping that ARR growth rate elevated while most of their peers have struggled, right? We can see here that over the last 2 years, they've been able to maintain this ARR growth rate in a band of 27 to 32% for the last 8 quarters, right? Which in this operating environment is tremendous, right? We're seeing most companies see their growth rate dip substantially. They spent $766 million on sales and marketing to generate that growth over the last 12 months. That gives them CAC payback of 28 months year over year, which is flat, pretty good in this operating environment. NRR came in at 114%, so really strong there. ARR per employee came in at 444,000, but they're still running pretty big operating losses. Operating margin was significantly worse year over year. That increased from negative 9% to negative 13%. And this was largely the result of lower gross margins. So gross margins down to 75% from 78% a year ago. And then G&A was up slightly as well to 19% of revenue compared to 17% of revenue a year ago. That all rolls up into about a $67 million operating loss for the quarter. But despite all of that, Cloudflare remains one of the more richly valued SaaS companies that we track. So they've got a market cap of just under 70 billion, or about 34 times ARR right now. All right, so we got the Figma IPO, and to say it was a successful one is probably an understatement. Figma set an IPO price of $33 per share. They issued 12.5 million shares in the IPO, secured 1.22 billion in additional capital from that offering. But now here's where the drama kicks in, right? When the shares began trading on the open market, the first trade occurred at $85, right? So IPO price at 33. First trade in the public markets hit 85, meaning the true market price was obviously a lot higher than the IPO was priced at $33 per share. And as I record this, let me just check this live in real time for you. Figma's share price is sitting at $90. It did run up as high as, I think, about $122 in a day or two post IPO. Now, if you've seen any commentary on the Figma IPO over the last couple of days, you'll see the statement that Figma left money on the table. And the idea behind this is that if you price the IPO at, say, $90, which is what it's trading at today, instead of 33, they could have raised almost an additional $3 billion in capital for the business without any additional dilution. Now, based on the early trading post-IPO, maybe that's a fair assessment, but that would have been an extremely aggressive price for the IPO. That would have given the company a market cap of about $37 billion, or about 37 times ARR. Yes, right, in the days post-IPO, it ran up to about 65 times Q1 ARR. But the most richly traded kind of public SaaS companies that we track at the moment are Palantir, Cloudflare, and CrowdStrike, right? And if we have a look at their ARR multiples, right, we can see CrowdStrike trades at about 25 times Q1 ARR, Cloudflare's at about 36, Palantir's obviously an outlier here, north of 100. But for Figma to be priced at 65, right out of the gate, that would have been extremely aggressive. If we think back to episode 22, where we did this pre-IPO deep dive on Figma, we looked at what we thought were kind of the most appropriate comps for Figma heading into this, right? And the companies that we came up with were kind of fast-growing companies at around $1 billion in ARR. And that gave us companies like Monday, Confluent, Rubrik, and GitLab, right? Now, Rubrik, interesting, I think, is probably the best comp here, right? Rubrik now is growing faster than Figma, so they generated 54% ARR growth, but they're only generating 17 times ARR multiple. And the reason for that is they're still running big operating losses and negative free cash flow, right? The advantage that Figma has is that they have positive operating margins and high rates of free cash flow, right? A company that looks more similar to them from an operating margin standpoint is Monday. Monday's not growing as fast. They're only growing at 30%, and they get a 14 times ARR multiple, right? Now, just for fun, because of the fact that Figma ran up so much in the days post-IPO, I wanted to compare them to kind of two of the highest flying kind of tech companies in the world at the moment, OpenAI and NVIDIA. Right, so OpenAI, not a public company yet, but as we're about to talk about, they just raised some funding and their valuation was at about 25 times revenue run rate, right? NVIDIA, public company, obviously we get their data every quarter. They're trading at 25 times ARR as well. So to come out and price Figma at like 50 or 60 times revenue was probably out of the question. And as we can see in the days following this initial pop, right, share price ran up to 120. It's since dropped back to about 90. I think it probably comes back and settles down even further than that. I wouldn't be surprised if Figma settles down and starts to trade more in line with companies like Monday and Rubrik, right? Somewhere around kind of high teens to early 20s ARR multiples, right? They're a fantastic company, but they're not good enough to be valued kind of north of 50 times ARR in my opinion. Final thing to cover today is the recent news that OpenAI has raised another round of funding. So the information reports that OpenAI secured about $8.3 billion in funding at about a $300 billion valuation, right? So that takes total funding for OpenAI to this point to just under 40 billion. For context here on the size of that kind of total capital injected, right? Their closest rivals from both a kind of business model and stage standpoint are Anthropic and xAI. So Anthropic's raised 18.2 billion, xAI's raised about 17 billion. So OpenAI miles ahead in terms of funding so far. They also reported revenue run rate surpassed 12 billion, right? So $1 billion a month in revenue for OpenAI at this point. And they're projecting that they'll go north of 20 billion in run rate by the end of the year. So 20 billion by the end of the year, that's up from a reported 5.5 billion at the end of 2024, right? So they're projecting to go from 5.5 billion to 20 billion in 12 months. Insane, right? And they're only generating a 25 times run rate multiple. This growth, right, is incredible. It's also outpaced what the insiders expected, right? So in late 2022, Reuters reported that OpenAI had expected to hit $1 billion in sales in 2024, right? As we just touched on, they ended closer to 5.5 billion at the end of that year. We're also expecting the release of GPT-5 any day now, and the master salesman, Sam Altman, is already hyping the release there, saying that there are a bunch of jobs that won't exist once GPT-5 is released. So interesting times here for sure. I'll be back next week with a bunch of Q2 results from the SaaS codes that we track. We're right in the middle of earnings season. I think I got the alerts just earlier today that we've had a couple more announced. Semrush, Sprout Social, those Q2 numbers are live, so I'll be pulling those into the Q2 State of SaaS data sheet later today. So if you want to get an early sneak peek into these companies as they report, I'll link to that below. You'll be able to get the master spreadsheet that I use to track all of these metrics before I compile the Q2 State of SaaS report. So if you want to grab that, get the link below. That's it for this week. Thanks for tuning in. I'll see you next week. Until then, goodbye.